Welcome everyone to webinar number 5, what we should be teaching our children or grandchildren about personal finance. We hope everyone's having a nice week. Hopefully everyone is healthy. You know, this second wave is a little bit, I don't know if scary is the right word, but unfortunate. You know, it's one of these days it'll all be over, but in the meantime, you know, like I mentioned in the email, you know, we love spending time in person with, you know, our clients and friends, and in the meantime, we just figured, well, let's try to do what's second best and try to communicate with some people and be helpful through these webinars. And your feedback has really encouraged us to keep going, and so we really appreciate you cutting out some time in your busy days to learn a little bit. And so thank you for joining us for webinar number 5. Today we have one of our other advisors, Mr. Patrick Gaul, who is going to be making his webinar debut. I know many of you on this call know Patrick already, but for those of you that don't, just a really quick background. Patrick grew up in the Pittsburgh area, ended up going to play college hockey at Notre Dame. And in those 4 years at Notre Dame, he earned his finance degree. And then, much like myself, had the opportunity to go play minor league hockey for a number of years and ended up down here in Charleston. And maybe, it was almost exactly 3 years ago, Patrick reached out to me and just said, you know, can I come into the office and just learn a little bit about what you guys do? You know, you don't have to pay me or anything, but yeah, I want to learn and see how you operate and build financial plans. And of course, you know, I said yes, and it didn't take long. It became very apparent that Patrick, it's hard for me to call him Patrick. You know, we're a lot of hockey guys. Usually I call him Gaul, or but trying to keep it professional here. But it became very apparent that Patrick had this skill set where I knew he'd be able to do really well in this industry, and I knew he'd be able to help our firm a lot. And so it wasn't much long after that, he finished playing his final year of minor league hockey, and he joined us full time. And he's just been doing an exceptional job. You know, a firm like ours, you know, a boutique, smaller firm where we're really customizing a lot of what we do, you know, both financial planning, tax planning, investment planning, and portfolio management. Like, it really requires to have a close-knit team and, you know, bright people and someone that can wear a lot of hats. And Patrick wears a lot of hats. I lean on him really hard. Of course, you know, he sits in meetings with me. He helps with technology, helping, you know, client portal, and more and more financial planning. So he's actually going to be sitting for he's a CFP candidate. He's going to be sitting for that exam this coming spring. And so I thought I'd kind of throw him in the fire here and have him teach on a topic here. What we should be teaching our children or grandchildren about personal finance. Just one last item. You should have a Q&A button down at the bottom of your screen. Feel free, like, as we go through the presentation, or if you have one right now, just type it in, and we will try to get to some of those questions at the conclusion of the webinar. So sorry for the long intro, PG, but
I don't mind it. That was a very nice introduction, and I appreciate it.
The tie looks nice too.
Thank you. Tied it myself. I think I've met most of you that are watching. I'm related to a number of you that are watching, which is good. But we thought this was a fun topic, particularly because, you know, Johann and I are definitely on the younger side of people in our industry. And when we're, you know, talking with friends and family members who are asking finance related questions, almost all of us, when we have a question as a, you know, kid or a young adult, you turn to your mom and dad for advice. And while, you know, I love my parents dearly and they've done a great job thus far, there are definitely areas of life that Joe and Peg Gaul are not experts on. So this is, my mom's listening, I think, might not love that, but this is an area that I think some people could really use some education, and that where I think our clients have a really good grasp on it. Oftentimes, you know, younger people do not. So just a little intro there. Of course, classic disclaimer, through this webinar, Oceanside Advisors does not render or offer to render personalized investment or tax advice. Information provided is for informational purposes only and does not constitute financial, tax, or legal advice. Obviously, we'd be happy to sit down with anyone that needed help or had questions, but that is not what this webinar is. Just a little intro here. This is going to be like kind of a step-by-step, someone that's younger or older, kind of getting your ducks in a row before you know, if your cash flow planning is lined up, then we can start talking about paying down debt, then we can start talking about investing. So it's kind of going to walk you through that process. And a lot of the questions that we're posing in this webinar are from either clients' children, our friends. Just we do help a number of young professionals, and these are very, very common questions that we get from them. How much money should I have between checking and savings? And this is a big one. I make more than I spend. What should I do with the surplus? Pay extra on my mortgage, pay extra on my car, you know, invest. And we will get to that shortly here. So let's start with the first question. What should I have between checking and savings? We call this your emergency fund, rainy day fund. You can call it whatever you want. We recommend, generally speaking, that you should have between 3 and 6 months expenses. I understand that for a lot of people that the difference between 3 and 6 months expenses is a lot of money. If you're someone that you and your spouse make similar money, you know, have pretty solid jobs, you feel comfortable, aren't going anywhere, you can kind of lean towards that 3 months expenses. If you're a single person who's, you know, you might have a commission-based job, you might be in real estate, that's where we would caution you to kind of lean towards that 6 months expenses. And with that, you can get really detailed in terms of what you should have sitting in your emergency fund. If you want to start talking, you know, like understanding your homeowner's insurance deductible, you know, your out of pocket for car insurance, out of pocket for health. You can also use those numbers to get a good idea as to what you should be sitting in a rainy day fund, you know, were something to happen. Last point on this front, if you do plan to make any major purchase, home, car, you know, cabin, boat, in the next 18 to 24 months, you know, we don't think that money should be in the market. Last thing you want to do is get ready to put a down payment on something and, you know, COVID spikes again and the market gets cut another 30%. So you have your emergency fund, you make more money than you spend, which is obviously fantastic. What should I do with the surplus? And we're kind of assuming that someone isn't going to come to us with this question to figure out what car or pair of shoes they should buy. So we're assuming they either want to pay down debt or start investing or investing more. When it comes to paying down debt, sorry, I'm yelling at you here in all caps, but we would say you should prioritize your debt. And just going to give you an example here of what we mean. Say you have a credit card, mortgage, Vehicle loan, I put that in there to make sure everyone was still paying attention. And for if any of my nieces and nephews are watching, there's a dinosaur for you. Vehicle loan and investments. So as everyone should know, all of your debts have an interest rate, and it's going to vary based on what the debt is, if it's a mortgage or a vehicle, when you got the loan. And when we say prioritize your debt, and we see this out of plenty of 60, 65-year-old people that come into our office too. They might have $60,000 sitting in their checking and savings account and $20,000 in credit card debt. And it is kind of mind-boggling to us when we see that, but in a scenario like that, priority number one is to pay down that credit card debt. When you get into, and bear with me here because I'm going to try and do some annotating. So you're trying to measure the opportunity cost of paying down debt versus potentially investing. If we could get 18% in the market every year, we would let this sit there. I think we all know that that's pretty unrealistic. So that's why we recommend you pay down your credit cards, as soon as possible, or don't carry credit card debt, period. Something like a mortgage, and this is where we like Dave Ramsey. We think he's great. We think he has a lot of good ideas, but we don't agree with him completely. If your mortgage interest rate is 3.5%, we have a lot of people ask this, like, should I make an extra payment on my mortgage? We would recommend or suggest that, like, if you were to invest that money over here, that you could probably earn more than 3.5% over a long period of time. So we're big believers in that there is good debt and bad debt, and this would be considered bad debt. This would be considered good debt. And this is kind of an in-between where, depending on how aggressive you're investing, 7%, we'd probably say you'd want to pay down that loan. Anything to add there, Yogi?
No, I think you
mute yourself.
Yeah, I did. I muted myself. I have these these cats that sometimes, usually I lock them in a room when I'm presenting, but yeah, they're just hanging out with me here. So I wanted to just mute myself in case they start meowing or something.
Yeah, that's fair. All right, super. So you have your emergency fund figured out. You don't have any credit card debt. You only have good debt. You might have a mortgage payment. You might have a small car loan with a low percentage. We're going to pivot to investing. And these questions are really funny to me because it isn't difficult to understand if you're ever taught it. But when we were in school, for whatever reason, they felt it was more important we knew what the Stamp Act of 1774 or whatever, 1920, I don't know when the Stamp Act was, but they felt it was more important that they teach us stuff like that than personal finance. So these are just kind of basic questions that we get that I think everyone should know. What's the difference between a Roth IRA and a traditional IRA, 401k and an IRA and a non-qualified investment account? Almost no one words it like this, but this is an individual account, joint account, a lot of times called a brokerage account. And then second question we get constantly, which is a good question, is should I contribute to Roth or traditional retirement accounts? Last one, how should I invest in my retirement accounts? And we'll get to these here in a bit. Let's start with the first one. Traditional IRA versus Roth versus 401k versus non-Q. IRA stands for individual retirement account. I get this question constantly when I'm talking to friends of mine, and I ask if they have an IRA, or we're talking about IRAs. I get the question like, how are IRAs doing right now? And it's a question that doesn't make any sense because An IRA is just a vessel that holds your investments. Whether it's an IRA or a Roth, it's going to differ how it's taxed, but you can put cash, mutual funds, individual stocks, bonds, ETFs, put any of those in an individual retirement account. But to ask the question of how are IRAs doing right now, it just doesn't it doesn't compute. There are differences between 401ks and IRAs. Essentially, all a 401k account is an employee-sponsored IRA. From a taxation standpoint, they carry essentially the same rules. There are minor differences, like you can contribute more to a 401k than you can an IRA, but for all intents and purposes, 401k accounts are just IRAs that your employer sponsors. Last one, non-qualified accounts, funded with money that you've already paid taxes on. Essentially, they're accounts that just don't receive any sort of tax advantage on the front end or the back end. So how do these accounts vary? Like, why do these different accounts exist? It's gonna be me yelling at you again here. It's the tax treatment of these accounts. And I'm gonna give you an example because it's, in my opinion, the easiest way to do it. For my nieces and nephews, you're about to see some piggies, so get excited. Say you have $10,000 to invest and your marginal tax rate is 20%. I went with 20% because it's an easy number to work with. There currently isn't a tax bracket, I believe, that would put you at 20%, but marginal tax rate being the last dollar you earn. So say your income for a year is $150,000. What are you being taxed at from 140 to 150? It's going to be your marginal tax rate. I mean, there's going to be deductions and whatnot, but just for the sake of example here. So you have $10,000 to invest, marginal tax rate's 20%. There you are with your $10,000, and we're going to put it into a traditional 401k. I think I meant to say this earlier and jumped over it. Again, like 401ks and IRAs have the same kind of tax treatment. You can also have a Roth 401k. It depends on if your company offers that or your plan offers that. The primary difference between 401ks and IRAs is within a 401k, you're going to be limited to the investment options within the plan. Whereas in an IRA, you have, whoever your IRA is through, whatever different mutual funds, ETFs, individual stocks that you can buy through their, through that custodian. So you're putting $10,000 into a traditional 401k plan. That $10,000 goes right in, no taxes paid on it on the way in. This is a question we get constantly. What happens if I buy Amazon when it's $1.23 a share in my 401k, and it's now whatever it is, $2,000 a share, $1,800 a share. Do I have to pay taxes on those gains? The answer is no. So if you sell within a 401k, within an IRA, within a Roth IRA, within a Roth 401k, if trading within the account isn't a taxable event. So then you get to retirement, you take the money out. Some of that money goes to you, some of that money goes to the IRS based on what your tax rates are at the time. Distributions from 401ks, IRAs in retirement are going to be taxed at ordinary income rates because you didn't pay taxes when it went in. So you get the benefit of deferred growth. Second example, there you are again with your $10,000. We're going to put it into a Roth 401k this time. Marginal tax rate's 20%. So 2,000 of those dollars are going to the IRS. 8,000 goes into your Roth 401k. Kind of like we said on the first one, any trading that goes on while the money's in that account, doesn't matter how big of gains you have, come retirement, none of those gains are taxable events, and come retirement, you have tax-free withdrawals. So you pay the taxes up front, up here, pay the tax man, $2,000 down here, you don't have to worry about taxes. Third example here, you're putting money into a non-qualified account. There's our, and my wife asked me to let everyone know these are pigs for the sake of piggy banks. I thought that was pretty intuitive. She was very confused as to why there were pigs on the screen, so I thought now was a good time to share that. So non-qualified account, it doesn't receive any kind of tax treatment or tax advantage. You still pay that $2,000 this time to the tax woman. $8,000 goes into the non-qualified account. Trading that occurs in the account, that's when the taxable event happens. So I made the non-qualified pig transparent because for the sake of the IRS, they don't care what goes on in this account or in this account. So you have the opaque pigs. Any kind of trading, buying, selling that goes on in these accounts, gains that happen, losses aren't going to impact your taxes. Whereas in this event, when you know, and we're not going to get into the actual, long-term, short-term capital gains and how all of that is taxed. Just know that if you do have a non-qualified investment account, when you buy and sell things, that's when you're going to have tax consequences. Withdrawals are not taxed because, you got taxed up here. I spent a lot of time on that last slide. This one, I kind of took the cheap and easy route. Should I make Roth or traditional deferrals? This is actually a picture that Michael Kitsis down here, who we use for a lot of our, he has a blog, he has a podcast, super intelligent guy, really good with the financial planning side of things. And I thought this is a great diagram to kind of explain, should you be making Roth or traditional deferrals? He kind of hit the nail on the head here with the title. There's no creativity put into this, but I think it's perfect. Pay your taxes when your rates are the lowest. Kind of seems like common sense, but what he's getting at is, so you get your marginal rate here on the side, high and low. Up top, we're looking at when it makes sense to contribute to a traditional IRA. Down below, we're talking about going with a Roth IRA. So you would want to contribute to a traditional IRA during your high earning years. So your current marginal rate is high, meaning say you're making $300,000 a year, you're paying 28% on your, I don't know what the actual number would be, but let's just call it 28%. And you're putting $18,000 into your IRA. Rather than pay 28% on that $18,000, you defer the entire amount, save 28% in taxes, goes into your traditional IRA. Come retirement, even if you require $300,000 to live in retirement, and again, this is actually a separate webinar if you want to go watch that one. Taxes in retirement. How your money is taxed or how your income is taxed in retirement differs from your earning years. So Social Security isn't taxed the same way that ordinary income is. Same thing with pensions. If you require $300,000 during your working years and $300,000 in retirement, you're likely going to be paying lower taxes in retirement still. The only caveat here or disclaimer would be that depending on how old you are, we have no idea what tax rates are going to look like when, I'm 30. I don't know what tax rates are going to look like in 35 or 40 years. Also keep in mind that these diagrams are likely describing the same person at different points in their earning phase. So me, when I was playing minor league hockey, not making a ton of money in the ECHL, I was contributing to a Roth IRA. 10 years from now, business is booming, things are going great. Oceanside's expanded. Maybe I'm making more money and it makes more money makes more sense to defer and contribute to traditional 401ks or IRAs. Another thing, which this is kind of more for our clients and less for their kids at this point, this description right here, or this image of why you're contributing to a Roth, you can think of this like Roth conversions too. So if someone just stopped working and you no longer have earned income, and you want to start converting money from a traditional IRA to a Roth IRA, because you're worried about when RMDs kick in and you have to start taking bigger distributions, that might force you into this higher tax bracket here. This is essentially what's going on. You might convert $20,000-$30,000 down here to try and balance the seesaw out to come down more later in retirement. This is a fun one here. So how should I invest in my retirement accounts? A lot of these topics I'm just kind of glossing over, like touching on briefly, because we could probably do full webinars on each of them. I know when I was 16 or 17, if my dad came home and tried to make me watch a 45-minute webinar once a week, I probably wouldn't want to do it. So we're trying to keep this brief and easy to explain to kids. This slide, however, is going to be a little all over the place. So we're kind of going to walk you through what we believe is a well-diversified portfolio, and why, when it comes to 401ks, a lot of the time the simplest option is the best option. So in the world of investing, you have equities over here, equities and fixed income. Equities being stocks, fixed income being bonds. Within the world of equities, you have large cap and small cap. You could also argue you have mid cap and micro cap, but we're keeping this as basic as possible. Large cap being large companies. You could also argue there's mega cap, but not important. So you have large company and small company. You have growth companies and value companies. Growth companies being, a lot of tech companies or growth companies. It's priced based on potential future earnings that may or may not happen. Value companies that have good, price to book. Their current revenues are strong, future revenues look good, but they're reasonably priced. And then you have domestic and international, and this is one that we believe in a lot, that you should hold a good balance of U.S. companies or funds that focus on U.S. companies and funds that focus on international, whether it's developed countries or emerging markets. That there's quite literally a whole world of equities that you should be participating in, and to have a patriotic bias to us doesn't make a ton of sense. Also keep in mind that in the equities world, you're going to have something that might be a large cap growth international company, or a small cap value domestic company. So in every situation, you're going to have one of these two, or more if you're counting micro and mid, one of these two and one of these two to make up each kind of equity that you're going to hold in a portfolio. A well-balanced portfolio is going to hold some of every permutation that you can make from all of these characteristics for funds and companies. On the fixed income side of things, a lot less exciting. Short-term, long-term, and then creditworthiness. So short-term bonds, long-term bonds, whether they're government or corporate, and then creditworthiness being, this is also whether they're U.S. government bonds, very creditworthy. Small company in Texas might be a $100 million company, probably less creditworthy. Particularly with younger investors, we, depending on what your runway to retirement is, we probably more so than your average company would recommend only holding equities up into a certain period of time. Reason being that, you know, if I'm 30 years old and I have 35 years to retirement, it doesn't make a ton of sense for me to hold any fixed income. If you have, and I'll kind of talk about this in a minute, but most people in their 401k have, you know, target date retirement funds. Those target date funds are going to hold, you know, if you're going to retire in the year 2065, you're going to be holding probably 95% equities, 10% fixed income. As you get, you know, every 5 years, they're going to start to shift from holding less equities and holding more fixed income to where the 2020 or 2025 target date might be 40%, 45% equities and 55% bonds or fixed income. How should I invest my retirement account? Oh, I gotta clear that. That's horrendous. Bear with me here. There we go, nailed it. So possible solutions, and this is tricky because no two clients' 401ks are likely going to be the same unless they work at the same company. And kind of like I said earlier, especially when it comes to investing in a 401k, we believe pretty firmly that simpler is often safer, particularly with, and we've seen this. We've had clients come in who you might have 30 funds in your 401k, and they kind of just blindly picked one based on how its returns were in the last year. And that one fund might have been a super aggressive tech company or tech fund that, yes, it did great last year, but that fund by itself is going to hold a lot more risk than, you know, someone that's 50 or 55 should be, or if they knew how aggressive that fund was, you know, they might not have made that decision. So possible solutions. Target date retirement funds. These are really good for people who want to set it and forget it, because you're gonna pick the target date retirement fund based on your age, the year you plan on retiring, and as we get closer to that target date retirement, or that target date, call it 2050, that fund is going to start to shift more from equities into fixed income. So it's going to become less and less aggressive the closer you get to retirement, which is typically what we would want to do. Second option, model or lifestyle portfolios. Depending on who's implementing the 401k plan, the advisor may have made, you know, their own company's model portfolios based on the individual funds that are in the plan. Or I know Vanguard, shout out to Callie and Joe. Vanguard has a conservative, moderate, and aggressive lifestyle portfolio that you can kind of pick, and at least you have an idea of what you know, how aggressive you're being. Callie and Joe are my sister and brother-in-law who both work at Vanguard, by the way. And then third option, possible solutions. We're clearly a little biased to this one, but work with a professional, because it's you can Google a lot of stuff these days, but especially with something as important as your finances, it's what source is credible, who do you follow, who can you trust, who has skin in the game in terms of, you know, reading, you know, you read an article about this company that's going to explode in the next 5 years, and it's, you know, that guy also happens to hold, you know, 20,000 shares of that company, so he has something to be gained from other people going out and driving up the price of the stock. So obviously, again, we're a little biased when we say work with a professional, but we really think it's a safe bet. Last slide here before we kind of wrap up, and I love this slide. We walk through this slide with the companies that we advise on 401ks for, because with younger individuals, it's really hard to grasp how compound interest works, gaining interest on your interest. So here's a little diagram of two examples here of Tim and Tom. And now that I'm using the blue marker, you might have to bear with me. But here we have Tim and Tom, two individuals. That was a really straight line. Tim starts investing at age 30. So at age 30, he's going to retire at 60, or we're going to look at his retirement balance at 60 at least. For 30 years, every month, Tim puts $1,000 in his, let's call it 401k. Tom, maybe he had kids, maybe he chose to buy a boat, maybe he just spends more than Tim or makes less than Tim. We don't know why, but Tom waited 15 more years to start investing. So he's now playing catch up. He only has 15 years to invest. So he doubles the amount he puts in for that each month for that 15-year period. So important, they've both invested the exact same amount of money to begin with, $360,000. We're taking the same expected rate of return, 8%, which over a 30-year period is, if they're invested aggressively, probably on the low end, but a pretty fair number to work with. And this is where it gets interesting and impressive. Interest earned, Tim, who started 30 years ago, now has almost 1.2 million in interest earned, where Tom has 336,000 of interest earned. Total wealth accumulation, Tim has now earned, he's got sitting in his 401k $1.5 million. Tom, just under 700,000. So Tim started, twice as early as Tom did, and now has twice as much money sitting in his retirement account. Obviously, if you can at 30 afford to put away $1,000 each month, that's great. The real message is that if sooner is better, if you can start making systematic payments or deposits, contributions when you're younger, the later you get in life, you're going to be really happy that you made that choice. And I know parents, I think this is something that they stress to their kids, and it's really hard for their kids to understand or care. And I think this is a really easy and clear picture of, they're both contributing the exact same amount to the accounts, just at different periods of time. And, the interest earned is, I think, more than 3 times as much for Tim versus Tom. So be a Tim, don't be a Tom. I have an Uncle Tom who I don't think is watching this, but don't be a Tom. So wrap up here before questions, just kind of bullet points if you are going to talk to your kids or try and encourage them or give them advice one way or the other. Have an emergency fund with 3 to 6 months of expenses. Once you got that sorted out, we would talk about prioritizing your debt. Not all debt is bad debt. And this is kind of where we fight Dave Ramsey a bit, that what's the opportunity cost of being debt free? I know a lot of people, might just want to pay down the rest of their car loan because they don't want to have it anymore. They want to own their car. They want to be clear. But if, particularly at the end of a loan, how little of that loan is interest that you're saving, because the way loans are amortized, you're kind of just paying off principal at the end anyway. You're not really saving yourself any money. So, or not enough to be worth anything. So what's the opportunity cost of being debt free versus, what you could potentially earn by investing that money? Roth IRA, you pay taxes when you contribute. So RC, Roth, contribute. Traditional IRA, you pay taxes when you distribute. TD. So Roth, contribute. RC, COLA. TD, Ameritrade. There we go. Contributing to 401ks, the simplest option is often the best option. Not always, but we kind of feel that it's not a bad play to go with a target date or a lifestyle fund or model portfolio if that's available to you. And lastly, the power of compounding. Start saving early. Be a Tim, not a Tom. So I hope that was helpful. Hope I didn't talk too fast throughout that, and you're able to understand me. Obviously, there will be a recording of this that we'll post eventually. If anyone wants to fire it off to a child, loved one, friend, whatever it might be. But thank you for joining us. And I think we're going to take some questions.
Yeah, you did a great job.
Thank you.
Yeah, for first webinar, that was much better than mine, I think. But you must have done a good job, because we have a lot of questions.
Oh, nice.
Obviously, there's a lot of thought-provoking material here.
Yeah.
So yeah, maybe we'll just, I don't think we're going to get to all of these, but maybe we'll do 3 of them. First question's from Paul. Maybe I'll just take this one, but Paul's wondering how 403Bs, 457s fit. How do they relate? I'm guessing that's what he's getting at, between 401ks and IRAs. So that's the simple answer, Paul, is 403Bs, 457s are very similar to 401ks. Typically 403B, well, there's all different kinds of 403Bs. There's like a 403B7 for like ministers, pastors, that kind of has its own set of rules. But a lot of times you see 403Bs for like nonprofits. A lot of hospitals will have those. Some schools will have 403Bs. But in terms of how they're taxed and how they operate, very, very similar to 401k. The same with a lot of times you'll see these 457s, right? And then the distinction there is sometimes they're government 457s versus non-government 457s. A lot of times you'll see 457 plans like paired with 403B, which gets even more complex. But certainly if you have a more specific question there, just reach out to us directly and we'll dig to the bottom of it. Another question from Mike Gaul, maybe you can touch it. This is an area we didn't touch on in this webinar, but it is important. Can you just go through the difference between, if someone's child or grandchild is approached on buying life insurance, just some of the basics of like term versus whole life, if you can maybe fit that in 60 seconds.
Yeah. Very generally speaking, we are much bigger believers in term life policies than we are whole life. Whole life often called like permanent life insurance. The reason being that we think that insurance should be used for exactly like what the definition of the word is. It's kind of in case something happens, not I don't think that if you don't use your insurance policy, not say you should be rewarded, but more so with how much cheaper a term life policy that's going to give you the same benefit or death benefit as a whole life policy, it might be 1/10 of the cost or 20th of the cost, depending on who you're going through. We think you would be much better served by, instead of paying that, 10 times the premium for a whole life policy, getting a term life policy and then taking the difference and investing that in a non-qualified account, an account that you could, access at any time. Whereas the whole life policies, depending on which one you're dealing with, they've got some pretty tricky, what's the cash value of this? What can I take out? What can I use this for? They vary a lot, but in general, we lean much more towards getting term life insurance for when you need to be insured, and whole life has some tax benefits that in certain circumstances might make sense, but very generally speaking, we push you much more towards term. Another thing that it just occurred to me I didn't mention during the webinar there when I was kind of breaking down the difference between putting $10,000 into a traditional IRA or traditional 401k or a Roth IRA versus a non-qualified is that the reason you might take that $10,000 and put it into a non-qualified is with your, and most of the people on this call know this, but you can't touch any money that's in an IRA or a Roth IRA for the most part until you're 59 and a half, whereas in a non-qualified account, you could, if you do need access to that money, you know, you can take it out whenever you need it, just pay the taxes on it then.
And then maybe last question here, and certainly if we didn't get to your question, we'll reach out via email. But question from Jessica, and this is a really good question, and a pretty simple one. But Jessica asks, how do I know which target date fund I should buy in my? So I think she's asking, like, how do I know if I buy the 2035 or the 2040 or the 2045? And maybe to add on that, Gaul, if you just want to touch on, you know, someone that has a little bit, if they're a little more averse to risk, maybe how you can adjust what your answer is.
Yeah. So those target date funds, I kind of mentioned it earlier a little bit that let's just say you're 30 years old. And you're going to retire at what is now like normal retirement age, 65. So you'd be looking at the another 35 years now, the 2055 target date retirement. That would be step one. You know, get an idea of when you're going to retire and pick that date. What Johann's getting at is, I'm 30. Say I'm in a 401k plan and I want to be more aggressive. I might know I'm going to retire in 2055, but I might, you know, every 5 years as they add in target date funds, I might go for the latest target date fund that they have because I know that target date fund is going to hold more equities and less fixed income. So, or the other way, if I'm going to retire in 2055, but I think I'm more conservative than the average investor, I might go for a 2040 or a 2045 target date fund that is going to be a little safer than, you know, a 2055. So the further out you go, the more volatile the more up and down that account's going to go, or that fund is going to go. But, you know, the idea being that if you have 30 years to recapture those losses, you should be okay.
That's perfect. Great job, PG. Wonderful.
Thank you.
We hope everyone else enjoyed the webinar today. Certainly, if you think of any other questions, feel free to reach out to us. The other thing, if there's something you're curious about and you're interested in us doing a webinar on that topic, yeah, we write these every couple weeks, and you know, we do these to try to help you. So if you have a good topic, certainly send it our way, and who knows, that might be the webinar topic a couple weeks from now. So thank you again for taking the time. And you got anything else, PG?
No. Yeah.
Great.
Thanks for showing up.
Awesome. Talk to you soon. Have a great week. Be safe.